Let me now make a couple of comments about China. This is what we call the Li Keqiang index. Now, Mr. Li is the Chinese premier. When he was the vice premier some years ago, and they asked him about the unpredictability or the unreliability of the Chinese data, he said, yes, I don't look at the GDP numbers. I look at rail freight, electricity production and bank loans. So everyone scrambled away and built an index called the Li Keqiang index, which is really the measure of really what's happening in China. And as you can see, the Li Keqiang index has collapsed. And that's why the people that say, no, 7% growth is wrong, it's really only 3 or 4, look at the Li Keqiang index. One of the mistakes that people make, and if you want to look at the different components of that index, you can see that rail freight has totally collapsed, electricity production is very weak, and bank loans have remained pretty stable in terms of their growth rate. So people that are looking into China and saying, no, we don't believe the GDP numbers, we believe the index, they're of course are telling us that China's really only growing at 4 or 5%. The problem with doing that is that you're only looking at one part of the economy. And the whole process in China is to try and rebalance the economy towards more services, towards consumption and away from investment. And the Li index really isn't capturing any of that consumer services side of the economy. So if you do have this big rebalancing, it will appear that the economy is a lot weaker than expected. For instance, if we look at services output as a proportion of GDP, the red line, you can see how investment, which is secondary output, was basically industrial production, construction, etc., the things that Australia knows and loves and the things that are helping our resources sector, that's now starting to slow, but it is being partly offset by this lift in services output, which isn't being measured in the Li index. And our expectation is that that process will continue unabated for a long time to come. And that, of course, has huge implications for Australia. One being, of course, that the boom for the mining sector is behind us. It's not going to disappear. We'll still have demand for mining goods. But the real issue for us is how we can position ourselves to take advantage of that lift in services output. If we think about if we think about it in a different way, business investment as a proportion of GDP in China, running at around about 45%, but starting to slow, and the government's objective is to slow it down by a lot more. And consumer spending running at around 37%, government objective to lift that. You think about an economy like the US, consumption's around 70% of GDP, and in China it's only about 35%. So as your standard of living rises, so you want to lift that particular number, which is directly related to lifting services output. And on the same basis, if you look at a country like Australia, where investment's about 20% of GDP, in China it's been running at 45%. So that rebalancing, once again, is a structural change that will mean that China overall slows down, but the makeup of the economy is going to change significantly. In terms of the short-term issues around China, the ones that will be important over the next 12 months or so, the really bad thing for us is the construction cycle is really on its knees at the moment. If we look at, say, real estate investment is the weakest it's been since the GFC. Construction starts have collapsed. So there will be a cycle in here. It's not that the pace of slowdown in these sectors will maintain this current pace, but structurally you will start to see an ongoing rebalancing in that economy. And that residential sector is starting to stabilise in China. If we look at residential sales, they're now actually growing for the first time for a number of years. Now, does it mean that the developers are saying, hey, we can now start acquiring new stock? No, because the inventories that have been unsold are still extremely high. So the construction cycle is going to remain elusively away from us, which will mean the demand for coal and iron ore, because 70% of the steel that is consumed in China, and China produces 50% of the world's steel. 70% it goes into this construction cycle. And we haven't really seen evidence yet that the new builders are actually moving into the market. We have started to see some evidence that prices are rising in some of the Tier 1 cities and even in some of the Tier 2 cities. Tier 1, Tier 2, Tier 3 represent about a third of the housing market in China. There's only 4 cities in Tier 1, but of course they're the big 4, and we're now starting to see prices rising. So the evidence of the construction cycle, which is much more important for China than the equity market, is that it has stabilised. So that's a positive sign. And with the success that they're getting in terms of lifting their services, we certainly shouldn't be writing this economy off. So if we think about the long-term structural story, yes, the rebalancing between investment and services. The short-term cyclical story, well, we're starting to see at least some stability in that housing construction market. If we take a longer-term view on the overall China story, then certainly we've seen a long-term structural slowdown in their growth. So even if, as we believe that the 7% is about right, we would still be expecting that number will be printing around 5 by 2020. If you're a Li index man, you'd be saying 4% now, but I really don't know where you're going to end up if things are slowing down and your starting point is 4. However, the important point for the world economy is that even though we're expecting China to slow down, if we look at their contribution to world growth, that's the white section, it doesn't change much. Even though they'd slow from 7 to 4, the contribution to world growth, we got world growth at around 3.1% this year, 3.6% next year. China's contribution is pretty steady. And that, of course, is because their economy is so large that they can still contribute a significant amount to world growth, even if their growth number is lower. So it's still an incredibly important story for the world economy. And as you can see, we're expecting that their contribution to world growth will remain significantly higher than the contribution of the whole of the advanced world, which of course is Japan, Europe, US. So don't underestimate China, don't write it off, but just remember that this rebalancing is important, and also feel somewhat encouraged that the cyclical story in China appears to be stabilising in that critical construction market.